Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news in the mining and exploration space. It has been a busy week for M&A, and joining me to discuss this is Joe Mazumdar, editor of Exploration Insights. Joe, welcome back to Kitco.
Thanks, Paul. Thanks for the invite.
We have a lot of M&A to talk about, but we have a couple of items to get through first. Leading gold producers Newmont and Agnico Eagle mines reported their March quarter results this week. Agnico had record earnings of $815 million US dollars, while Newmont posted $1.9 billion of earnings. Agnico's production was up a smidge, whilst Newmont's was down 21% over the last quarter due to its asset divestments. Agnico's all-in sustaining costs fell 10% to $1,183 US dollars per ounce, giving it a 59.1% all-in sustaining cost margin, some $1,708 per ounce. However, Newmont's all-in sustaining cost increased 12.9% to $1,651 per ounce, giving it a margin of 43.9%. Joe, Agnico continues to set the pace in the gold sector. Now that Newmont's got its go-forward portfolio, can its performance catch up?
I doubt it. What Agnico's done, and I did a study on this for my subscribers a couple of weeks ago, where I looked at the full year 2024 financials, maybe a month ago, and I gauged it by how well these 21 companies, North American listed companies, did in 2024 returns versus Q1 2025. And there were 6 companies that did well in both 2024 full year and Q1 2025. And in terms of the majors, super majors, if you want to say, Agnico was the one that outperformed easily. And part of that is that not only do they offer high margins and incredible margins for such a large company, but also they offer dividends. And the other big deal is that they consistently meet whatever guidance they put out. And this consistency is what investors are looking for. So, people talk about an income stock versus a growth stock and what are people looking for. And what I saw was the companies that outperformed were a spectrum of growth and income stocks. The biggest common theme was execution. Whatever strategy they had was the execution of that strategy. And Agnico has by far exceeded expectations with respect to execution on their strategy.
Returns to shareholders seems to be the capital allocation of choice for many companies, and to take advantage and share this metal price bonanza. So it seems like it's finally harvest times for gold cos and gold company investors. However, the dividend yields are quite small, quite thin. Newmont's returns to shareholders in the first quarter, $630 million. Agnico's at $236 million. Paying out dividends is an important qualifier for several institutional investors or several funds to be able to invest in these companies. But should they increase their payouts to get a better yield to attract even more investors?
Well, if we look at Newmont, because when they bought Newcrest, that was an all-shares transaction, so they blew out their share structure. And when you blow out your share structure, to keep the same kind of dividend policy is next to impossible, because the payout would be severe. So they had to lower their dividend yield to maintain a similar overall payout. Agnico, when they've made acquisitions, they've been acquisitions that have, been pseudo transformational, but they haven't been the kind that integration with the entity that they're merging with would take them over a year and would involve a big divestiture plan and stuff like that. And Newmont's done 2 of those with Goldcorp and with, almost 3. Goldcorp, the Nevada Gold Mines thing with Barrick, and now this with Newcrest. Agnico has done more integration with assets, like even though it was Kirkland, it was Fosterville, Yamana, Canadian Malarctic, that sort of thing. And the integration was a lot easier because it was on the operational side. There was less on the corporate side. When you start integrating corporations, balance sheets, and that, it gets more difficult. And Newmont's navigated that very well on the divestitures, and hopefully they'll reap the rewards going forward, but they're reaping the rewards on the numerator, let's say on the cash flow side, over a much bigger share count. And Agnico has managed to keep their share count, manage it a lot better.
Now, both Newmont and Agnico bought back a lot of stock in the first quarter. Newmont actually gave back more returns to shareholders by buying back stock than in dividends. Pretty much all the gold companies have normal course issuer bids out or in place at the moment. It's very rare a gold company that doesn't have one. So it seems that gold companies are intent on using this metal price bonanza to really bring down their share counts.
Yeah, I mean, the thing is, if you look at the valuations, it sort of theoretically makes a lot of sense because they're still trading at like 1.1 price to net asset value, and when I worked at corporate development back in the late 2000s for Newmont, the PNAVs were like over 2 easily. I don't think they'll ever get back there, but if they see that that we could get back to 1.4, 1.5 or something like that, then it makes sense for them to say, yeah. In this environment and how we're valued compared to the gold price, our shares should be going up. And so, our best return is actually buying ourselves. So that theoretically, that does make sense.
Okay, now it wouldn't be 2025 without a news item on US President Donald Trump, and we have a couple today. US Interior Department plans to fast track mining projects, permitting of mining projects under emergency procedures to accelerate the development of domestic critical mineral and energy projects. The agency said the measures would fast track projects from a multi-year process down to just 28 days at most. Joe, 28 days permitting, pros and cons. Let's discuss that. Wow, 28 days. What do you think of that?
Well, I mean, I'd love to see it executed. I mean, the problem with the current U.S. administration is they come out with some theoretical timelines at what they're going to do, and then executing that is a completely different thing. And it's hard for me to think. I mean, I'm encouraged by the fact that they're doing this because I do think the process, the NEPA process, takes a long time. You say, oh, hey, we're in the process. Yeah, we'll get a permit in 5 years. That is too long. Going from that to 28 days, probably a bit of a leap of faith, especially since you basically let a lot of the government bureaucracy go. So in terms of accelerating the process without the bureaucratic means of doing it, is a bit of a conundrum.
Now, when I speak to CEOs, they say one of the aspects of permitting that means that it takes so long is the 3 or 4 years of lawsuits that they have to deal with as and when permits are delivered. And surely, if permits are delivered after just 28 days, that will provoke a wave of lawsuits, and projects are going to be potentially tied up for much longer. Joe, if you were the CEO of a junior developer, how would you respond to being given a permit in just 4 weeks? And how would you sell that to your local stakeholders and convince them that, yes, you're going to take care of the environment and their social concerns if you've just got a permit after 4 weeks?
Yeah, the thing about mining companies, I mean, because they're building assets that last 10, 20, and sometimes 30 years. And so, they're on the cutting edge of social license to operate. And whatever that was called 40 or 50 years ago when I started, it's still always been there because the mining companies are the ones that are on the ground talking to people and dealing with it. And if they don't have a good relationship with the locals, and locals meaning a lot of stakeholders, it could be the local ranchers, it could be the local town, it could be the local indigenous community, it could be hunters, it could be whomever. If they don't have a good overall relationship, it doesn't matter if the federal permit, if you get it. And we saw that with the Trilogy Road incident. They were a good proxy for Trump coming in with respect to that road permit. But it doesn't change the dynamics on the ground. Because, I mean, administrations come and go, but this mine would theoretically be going for 10 to 20 years. It does put a burden, I would say, probably on the NGOs and these people that combat mining projects, because they wouldn't know where to start, because usually they can see when a record of decision is coming up for a certain project and know where to allocate their limited capital. Now, if they get a whole bunch of them coming at the same time, I'd like to see them how they sort of allocate their resources and which ones they try to fight. I know resolution is one that's that's probably a number one priority of the administration to get forward. I don't know how that changes a project like Pebble, though, because that has more a larger breadth of people that oppose the project. Maybe if they came up with a different mine plan that worked with all the stakeholders, maybe that would work. I don't know. And everything in that's in the impacts the boundary waters in northern Minnesota. Does a 28 day permit change what people think about those projects at the state level? Because you need both permits as well. Usually the state's easier in like places like Arizona and Nevada, obviously, but in some other states, the state could be actually harder, especially if the federal government's using 28 days as their timeline.
The Sierra Club, which is often an anti-mining NGO, said there's no way the federal authorities can adequately review the various environmental implications and impacts of a project in just 28 days. I've tried to create a very flimsy link to the Sandra Bullock film, 28 Days, in which she plays an alcoholic going into rehab about Trump. But the best I can do is come up with another Trump news item as talking about what he's doing with minerals policy is so addictive. Also, in the last couple of days, Trump has given a green light for seabed mining. Joe, are you a fan of seabed mining?
Not really. I mean, I think it's more about economics. It's not cheap. There's not a lot of tonnage you can get out from the seabed, so it's got to be very high grade. We don't know what we're impacting when we mine this. And I mean, in terms of costs, there's still a lot of projects that you could do on land before you have to think about doing seabed mining. It's incredible when the price goes up, people want to mine the oceans and mine asteroids as opposed to mining the thing that's right there. And it's a little bit of the not in my backyard sort of thing. But when the further it away from us, with the less environmental issues we have with it, I guess.
The NIMBYs would perhaps be pleased with this. But for the rest of us, it's perhaps a wait and see to see how this does manifest itself. Now, let's turn to what has been a very busy week for M&A, mergers and acquisitions. At the start of the week, NovaGold Resources and Paulson & Co. bought Barrick Gold's 50% stake in the Donlin Gold project in Alaska for $1 billion. Donlin is set to produce more than 1 million ounces a year for more than 27 years from a 34 million ounce reserve at double the global average grade of more than 2 grams per ton. A wonderful conference call this week featuring a virtuoso appearance by Dr. Tom Kaplan that undoubtedly helped NovaGold rise 40% on the news. Barrick Gold CEO Mark Bristow laments the lack of tier one gold projects with a lack of scale and a lack of long life, and yet he's walking away from one of the biggest projects out there. So I have a lot of questions about this. Joe, why is Barrick walking away from Donlin? Why wasn't this transaction the other way round, with Barrick, which has some $5 billion of cash on its balance sheet, buying NovaGold, which had a market cap of about $1 billion prior to the announcement? Why isn't it that way round?
Okay, so there's a long history with this project, Donlin Creek. When I used to work for Newmont in Corp Dev, we looked at this to buy 50% of the project by acquiring NovaGold. The attraction, obviously, is like you said, it's a big resource, big reserve, a long mine life, a kind of a layered asset that you want in a large project. It's got all those elements. It's got some issues in terms of being remote, needs a lot of power, or you got to generate your own power. You're talking about probably a $7 billion plus upfront capital ticket. It's probably much higher than $7 billion now. I believe the last study was, I think it was 22, maybe. So still in the time of COVID. So if we look back in 2006, Barrick bid on NovaGold. And this is, for me, was interesting because Barrick bid on the NovaGold and they bid $14.50 a share. right now, I mean, they're spending 1 to 1.1 billion with that debt to buy the 50%, and then they're doing a financing at about $3 per share. And so it goes to say, like, when they got offered $1.29 billion for the company, I mean, 100% of Galore as well at the time, but at that time, Galore wasn't valued very highly. But gold price was about 20% of where it is right now, but they offered about the same price. So, I mean, what does that say? Why nobody else bought that project is of interest to me, not just Barrick, because Barrick's balance sheet is okay in terms of the end of 2024. They've managed to have a good balance sheet, but what they're looking to do now, their growth projects is Reko Diq in Pakistan, which phase one of that $6 billion upfront capital, probably going to be higher, and then they want to expand Lumwana, a copper project in Zambia. That's another $2 billion. So right together, right there, that's about the same upfront capital as you're going to need to build Donlin, and they can't do two of those. And they're trying to go forward with copper exposure. Donlin wouldn't be it. And also Donlin is refractory, and so the power, exposure is even higher. Like at one point when I was, I mean, it's a weird sort of thing, but I mean, we were looking at the project, the power needs were such that, some people were talking about trying to get a nuclear sub in there to power it. So that's how much power you need. And that power exposure hasn't changed with respect to the scale of that deposit. And remote projects tend to have more risk of capital escalation than projects that have more infrastructural benefits.
Now, the project is a massive scale project, and it would also require one of the biggest tailing storage facilities ever constructed, which includes a 471-foot tailings dam and a gas pipeline construction of 315 miles across 452 streams, pointing out to your point there, Joe, about needing to power itself. Although the project is largely permitted, the project is still in federal court about the potential impacts of a theoretical release from that massive tailing storage facility. Joe, are some of these, the development, the scale of the development, as you say, poses a number of risks in terms of being able to deliver on time and on budget, but also the potential environmental risk. I mean, on a massive project in such a remote area, there's potentially so much that could go wrong.
Yeah. Well, they need a water treatment facility into perpetuity for that project. So the project itself is 30 years. So you would need that water treatment facility for construction, whatever that is, 3 to 5 years, another 30 years or plus for the mine life, plus infinity and beyond. You would have that liability no matter what happened, an earthquake, what happened, whatever. I'm surprised, granted not under the current administration, but a lot of countries are asking for dry filtered tails for these projects in semi-remote areas, but also in places that are maybe tectonically risky. And I don't know. I don't think under this current administration, because the federal permit's already there, that they would ask for it. But that those sort of things are being asked of a lot of big copper projects as well, like in Chile and that. Again, they've already got the federal permit, and under this U.S. administration, they're not going to open that can of worms again. But this is like a 30-year mine life. I doubt if it's going to come into construction during the current U.S. administration, because you need about $7 to $10 billion to build it. And they would need to get an operator in the end, unless they build their own team themselves. It's going to be a big, complicated project, and also their strip ratio, because it's such a big project, their strip ratio is, even though it's not huge, it's still going to be a lot of waste as well. And if they even change the angles to to get more slope stability, that will increase the strip ratio and give you a lot more volume of waste just because of the size of that project.
Joe, is it possible to build a filter press for dry stack tailings for such a large project?
It doesn't exist. Yeah, it doesn't exist right now. Like I know when I looked at Vizcachitas in Chile, that's obviously in a tectonically active place, and it's also in a steep valley. And they have the only way they can get their permit is to do dry filter tailings, but nobody has ever done dry filter tailings for like a 90,000 ton per day plant. It doesn't exist. So that puts a lot of execution risk if that ever. I mean, right now Donlin doesn't require one. I'm not saying that they ever will, but that is something that some governments or countries are asking. In terms of, and that's got to be a technological step we make going forward to get some of these projects permitted to offer people a more stable long-term tailings facility. But as you point out, it's still very risky in terms of just we just don't do it right now. We do it for small gold projects that the throughput's much less. But if you get that filtration wrong, you basically shut down the plant. All you're doing is mining and stockpiling. You're not running the plant.
Okay. Well, let's put the spotlight back on Barrick again. Gold price is what, 3,300 US dollars per ounce. So it does seem that Barrick is also taking advantage of the high gold prices to clear out some of its closet, a bit like Newmont successfully did last year. You expect other things to come out of Barrick?
I've heard that they might be selling Hemlo as well. Because I mean, like I said, they need about $6+ billion for just phase one of Reko Diq and another $2 billion for Moana. So they might be looking at, as opposed to going to the equity markets or taking on more debt than they want to, looking at divesting. And right now, it's a good market for smaller companies to take over assets that people don't want anymore. Like you saw, like with Discovery Silver and taking over the Timmins projects of Newmont. This is a good market for that, and because those companies can raise equity and raise funds to purchase it, because what they want is cash. They don't want equity in a junior company.
Now, on another note, Joe, with the exception of the Nevada Gold Mines joint venture between Barrick and Newmont, this transaction that means none of the top three gold miners have mines or projects in the United States. Is this telling us something, or is this just an interesting conversation piece?
Yeah, just an interesting conversation piece, because I mean, it's still two of the largest companies. I mean, that combined Nevada Gold Mines produces about 2.6 million ounces of gold. I think the U.S. in total produces like 5.3, 5.4 million ounces. So it's still a significant asset. And Nevada Gold Mines is a joint venture, but it's full of a whole bunch of mines in it, which was the case before the joint venture happened. And then the idea of putting it all together is all about the processing facilities. But I can tell you, that if any of those companies had AngloGold Silicon Merlin project, they would absolutely want it, and they'd build it. So Nevada's best jurisdiction, so you'd want assets there.
Well, that gives us our next cue in staying in Nevada. Triple Flag Precious Metals is to buy fellow royalty and streaming company Orogen Royalties for 421 million Canadian dollars at a 38% premium to obtain the 1% net smelter returns royalty on the project you just mentioned, AngloGold Ashanti's Silicon project. Orogen gets to spin out all of its other interests into a new co. Orogen stock was up 28% on the announcement, while Triple Flag was down 1%. Triple Flag is building a strong royalty portfolio in this region near Beatty in Nevada, as it already owns a 2% NSR on the Motherlode deposit and a 0.5% to 5.5% NSR on Bullfrog, which is owned by another company. Joe, Orogen is a company you know very well, and you have been following the Silicon project for a long time. This seems to be a great result for Orogen shareholders, a big sale, and they get to keep almost all of the rest of the portfolio.
Yeah, It was, yeah, but this was a long-term hold that we've had for a while, and it's all about really the alpha part of the play. So, I mean, royalty. They just became a cash flowing royalty company. Orogen did a couple of years ago with their 2% NSR royalty on the Ermitaño project, a gold silver project in Mexico run by First Majestic. And so that underlying was very important because they were generating cash from this other royalty, so they never had to go back to the equity markets again. So they kept their share structure tight. And so when you say, okay, they got bought out for $2 a share, which equates to your $421 million takeout, about 82% of that was the actual royalty, the 1% NSR on Silicon Merlin. Silicon Merlin, combined is about 16 million ounces right now of total mineral inventory. You take that and then you convert it to US. That's about 247 million US. If you take the 421, convert it to US, which is about 300 million. Take 82% of that. So 247 million of that acquisition in US was actually for the 1% NSR. And why was it so much? Because it fits a lot of what you got, a high demand because you got a lot of royalty companies out there that want, tier one jurisdiction assets, tier one size, which they get here with the 16 million ounces contained right now, and tier one companies that are operating them, because the company that owns the asset is the company that's going to build it. Because, I mean, AngloGold Ashanti is keen on putting out a PFS towards the end of this year on the project. And I think Orogen did a good job in selling at probably the peak of the valuation, as before they get to the PFS, they just put out their updated resource. AngloGold Ashanti did when they updated their reserves and resources. So I think that was a good time to sell. But they definitely told, the royalty companies that if they don't get the price and the structure of the deal they want, then they'll just keep the royalty, which they don't need to sell because they have that 2% on Ermitaño and they're making money. So that gave them a long wick with respect to negotiating and getting the price they wanted. So that was definitely part of the deal in terms of making the deal work.
Well, I know it was a big win for you there, Joe. So congratulations there. Talk to me a little bit about how perhaps Triple Flag came up to their sort of $421 million Canadian valuation for that 1% NSR. AngloGold, as you mentioned, they've got a PFS coming out, so we don't really know what the final production profile may be yet. But doing a bit of back of the envelope math, assuming 500,000 ounce a year production for 20 years at a $3,000 per ounce gold price, that means the royalty would gross about $300 million or $15 million a year over that 20 years. The NPV on that is negative 100 million, and the payback is very, very long as well. What am I missing here? Why is this a good investment for Triple Flag?
So the number, the time zero number, the original investment, I would put at 247 million. And you're right, in terms of an MP basis, doing your math, it doesn't look very accretive. But what we have to look at is that it's predicated on potentially a higher gold price, and also predicated on the fact that they've had incredible resource growth at Silicon Merlin over the last few years. I mean, they only started drilling this project in 2018. So it's gone from 0 to 16 million ounces in that time frame. And so is there potential for more? That's what Triple Flag believes. And also, there's not a lot of these sort of long life gold assets. So what a lot of these royalty and streamers are doing is to say, okay, invest in me and not a producer, because I don't have the capital cost escalation. I don't have the operating costs, but I do give you exploration upside, which this still does. But also, what I'm doing for you is also exposing you to a long life. And the only way they can do a long life is usually doing a stream on a copper or a base metal asset. And that's how you get, 20 to 30-year life that you can average in with your 8 to 10 year life average for a gold mine. To get a 30 potential year mine life in a gold asset is hard to do, and to get it at the ground level. So that is another big positive. But also, the Merlin deposit that we're finding out with the hundreds of thousands of meters they drilled with infill last year, they're finding a very high grade portion of it. They're pulling back intersections of 144 meters of about 10 grams. So what they're thinking is the mine plan might bring some of this high grade up forward. So in terms of your flat production, it might actually be higher in the first 5 to 10 years. And that'll get you a better payback, especially at a higher gold price. And so that's probably a lot of where their math is.
Okay, well, I appreciate the detail there, Joe. Thank you. Now, Ross Beatty does it again. CMOC Singapore, China Moly, is to buy Ecuador gold copper developer Lumina Gold for 581 million Canadian dollars in cash with a 71% premium. Lumina Gold up 34% on the news. CMOC will obtain the 21 million ounce Cangrejos deposit in Ecuador that I visited in December 2023. A PFS that year detailed a phased development produced an average of 371,000 ounces a year of gold and 41 million pounds a year of copper, or about 469,000 ounces of gold equivalent, from an open pit for 26 years, following an initial capex of about 925 million US dollars. Cangrejos also contains silver and molybdenum. A feasibility study there is due out in the June quarter. Joe, despite its size, Lumina and Cangrejos have, it seems, always struggled to excite investor interest, as evidenced by Ross Beatty accumulating a 27.8% position, as he's largely funded the company in recent years. Why is that, do you think?
Well, I would say that, the asset itself is rather marginal. I mean, it's like the reserves are like 0.5, 0.6 grams per ton gold, but it contains about 11.5 million ounces. That's the attraction. The copper grades are like 0.1%. So they will be producing a gold-rich copper con will be the majority of the revenue, and a little bit of a gold silver doré. And the upfront capital is about $1 billion. And so that would be a huge overhang on a single asset company that, here's my project. It cost me $1 billion. And then I would have to raise, even if I could get debt, maybe 30% of my equity for that $1 billion would be, that's what I have to raise, which would be about $300 million US. And, that far exceeds their market cap, just the equity portion they're going to raise, not even including the debt. So there's no way the market thought that they could build it or fund the construction. And so, the retail support wouldn't be there to support the stock. What do you do with this going forward? You have a higher cost of capital than potentially this Singaporean acquirer. So the sell makes a definite reason, but to your point, they got on the US 420 million was the acquisition, converting the 581 over 20.5 million ounces on a total mineral inventory. That'd be about $20 to $21 per ounce in terms of enterprise value, let's say value acquisition cost per ounce. The average enterprise value per ounce is about $59 right now, according to Ron Stewart of Red Cloud Securities. The middle number is 33. So obviously this number is way below that. And even if you did it on a reserve basis, they still fall below the average. And that's probably, due to the grade, due to the upfront capital required with respect to, the size of the company, but also due to the fact that it's in Ecuador.
Joe, I mean, that's, as you mentioned, quite a low number, but it's not just Lumina that's getting a sort of low valuation number. Other developers aren't really necessarily knocking it out the park when they're acquired as well. It seems developers are not getting the gold glow when they're being acquired.
Yeah, I mean, the reason that the developers are still sitting in this no person's land, let's say, is because their cost of capital is very high, and every retail basically. I mean, this is the quintessential orphan period. And we don't see them getting funded. There'll be some projects that get funded that'll be ideal because people think that they'll get acquired. And so we're waiting for a lot more of these development assets to start getting acquired, as we've seen the production assets get acquired, whether it's the Newmont divestitures and other producing assets, Calibre, Equinox, those sort of mergers. Right now, are people, because people are willing to pay the premium to avoid the permitting risk, the capital escalation risk, any operating hiccups and stuff like that. They're willing to pay a premium for that. But are they willing to now take that risk of building these projects with higher capital numbers than they suspect, and potentially permitting delays? But if what we're saying, or you're saying, with respect to what Trump's trying to push, or his U.S. administration in terms of the U.S., this might be the time to start acquiring some of these development assets in the U.S. if permitting is going to be much quicker. That the window might be much quicker. So to acquire some of these pre-feasibility study, feasibility stage projects in a state that wants it, no big social issues, water access, all that sort of stuff. Maybe this is the time to start acquiring those sort of projects. That's something else to think about.
Earlier this month, Ecuador re-elected Daniel Noboa as president, and he's very pro-mining. So Ecuador should be pro-mining for the next 4 years. Should be a good time to develop mines in Ecuador. However, a potential wrinkle here. Solaris Resources, a copper developer in Ecuador, was blocked last year from receiving a $130 million Canadian investment from Zijin Mining by the Canadian government. CMOC is a Chinese company, and Cangrejos has copper. However, CMOC is buying this project via its Singapore subsidiary. Joe, is this a move to get around perhaps the Canadian Investment Act review and not suffer the same fate that Solaris suffered last year?
Yeah, no doubt. Solaris got around that by making some corporate moves, and it's not about the listing as much as the location of management, and basically taking management out and switching them around, and now the transaction can happen. I'm sure that if that happens with Lumina, they can organize something similar. I don't think it's such a big deal. But I think also with where Canada is in the middle of an election, and the issues with the southern neighbor, they might have other things to think about than stopping these little minor transactions that don't really matter to them because the copper was never coming to Canada anyway.
Okay, another Ross Beatty M&A transaction that will have a shareholder vote next week is Equinox Gold's all-stock merger with Calibre Mining. There's been criticism about a lack of synergies in this deal, whose main attribute is gaining scale. To get the deal over the line earlier this week, Equinox improved the exchange ratio from 0.31 of an Equinox share for each Calibre share to 0.35. Calibre shareholders will now own 39% of the resulting entity and not 35% as previously. Proxy advisory firms ISS and Glass Lewis liked the sound of this and recommended the deal. Joe, does this indicate that Equinox was perhaps having trouble getting the deal over the line and therefore had to be more generous in its terms to Calibre shareholders?
Yeah, because the thing is that the gold price had gone up so much in the interim, and the Calibre shareholders would have thought, well, this is the perfect time to own this stock because Marathon's going to come online, become commercial in a rising gold price environment with the construction almost done. But now we're getting diluted by all these other assets that we don't want exposure to, maybe. So they said, well, to keep this transaction going or afloat, there's probably enough people that said, well, maybe we don't want this, because I gather they needed a 2/3 majority, that they had to offer more. Whether that's enough is a good question, because if it's not enough, then there's the break fee, but then there's also that loan And then, obviously Calibre is going to have to go back to the equity markets to raise that last quantum of capital to finish the project and getting it into commercial production.
The Calibre shareholder vote will be on May the 1st, which is next Thursday. That's all we have for today. Joe Mazumdar, thank you very much for joining us.
Great. Thanks very much.
And of course, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.